Crypto products and NFTs are unregulated and can be highly risky. There may be no regulatory recourse for any loss from such transactions.
Hello and welcome to ETMarkets Crypto Q&A. I'm Aloni Bhatt. Today we have Parth Chaturvedi, lead crypto ecosystem at CoinSwitch Kuber, who will respond to all your questions. Now, Parth is a crypto native since 2018, and before his role at CoinSwitch, he was a management associate at Falconex, which is a digital asset trading platform headquartered in the US.
Hello, everyone. Hi, this is Parth Chaturvedi. I'm a crypto ecosystem lead for CoinSwitch Kuber. We've been doing these sessions on important topics within the broader crypto and Web3 space. Today's discussion is going to be around Bitcoin and why it is, the most important cryptocurrency out there. So, first of all, the basic question that everybody asks is, what is Bitcoin? So Bitcoin was actually the first ever implementation of, blockchain in general, how we know it today. It was the first cryptocurrency released by a pseudonymous person or group of people that was referred to as Satoshi Nakamoto. The timing as to when Bitcoin came around is extremely important to understand because it happened just after the 2008 financial crisis. So it was sort of a take on how the centralized banking network had failed us. So what is the primary purpose of Bitcoin? So coming from that, history that it was born right out of the, financial crisis, the primary purpose of Bitcoin was to decentralize peer-to-peer transactions. So Bitcoin is a decentralized digital form of money that can be transmitted from a user to another using the peer-to-peer Bitcoin network without any middleman. The differentiation here that you need to know is Bitcoin as the asset versus Bitcoin as the network. Both of them use the same name, but represent like different things. So Bitcoin can be used as a medium of exchange where you can transfer value over the internet, or you can actually use it as a store of value as well when you take it as an inflationary hedge and other real world assets are increasing in price. Bitcoin is also trying to move away a little bit from the basic function of peer-to-peer transactions, as there are some developers trying to build smart contracts on top of it. But this remains like fairly limited and is not as an ecosystem as vibrant as Ethereum's. So the next question that we get is, how does Bitcoin work? So the Bitcoin network basically relies on blockchain as the underlying technology, which is a shared public ledger. So when we talk of the Bitcoin network, think of the blockchain network that is supporting all these transactions and the asset class. All transactions that happen are included on the blockchain, which, as we know how blockchains function, is immutable and cannot be tampered with. Verifying these transactions and eventually processing them depends on Bitcoin miners. They form an integral part of the Bitcoin network because they add new blocks of transaction onto the blockchain. How do they do that? They basically solve a puzzle a mathematical puzzle using computational power to verify a particular block of transactions is correct or not, and in the process they get rewards as earnings. So the entire ecosystem or the network comprises of nodes, excluding the minor nodes, which maintain a decentralized distributed ledger that records all the transactions that are happening on the network. Related question to this, which a lot of people try to wrap their head around, is what is Bitcoin mining exactly? Is it similar to mining that is done for natural resources? Well, it is the digital or technical equivalent of mining for real world commodities. It is basically, as I mentioned, it's a process of solving a computational puzzle using computational energy or your laptop basically. So in the initial days, the computational power that was needed to solve these problems was so less that you could mine Bitcoin using your laptop. But as and when more miners got onto the network, the problem keeps on, so this problem adjusts its difficulty level based on the amount of computational power that is put on the network. So if more computers come onto the network, the problem becomes more difficult. And because of the way the network has expanded, and now there are, it's almost impossible to mine Bitcoin using laptop. You need like special GPUs or graphic processing units and special ASICs, like special machines that are only made for this purpose. Miners have become like very skilled, and they've increased their scaling operations by a lot. So now they have like huge Bitcoin mining farms as such, where a lot of hashing power is being put to solve this computational problem. So what happens is that once you are able to solve this problem, you get to add the next set of transactions as a block onto the blockchain. And in the process is when new Bitcoin are released into the system as a reward to the miner for verifying the transactions. So the only way that new Bitcoin is generated is as a mining fee reward that miners get for adding new blocks onto the blockchain. This sort of acts as an incentive, for miners to maintain the strength of the system and keep putting in more computational power to solve this mathematical problem. In a sense, the whole network for Bitcoin is, the security for it is guaranteed in the computational power and the energy that is involved, in solving this problem. How are these rewards calculated? So how are the incentives for the miners calculated? Again, it is a thing of beauty to see, like in terms of a mathematical algorithm. Within the Bitcoin algorithm, there is a fixed amount of Bitcoin that is released for adding each block to the blockchain. This number started off with about 50 BTC. So in the initial days, whenever you added like one blockchain, one block to the blockchain, you used to get rewarded 50 BTC. That number keeps on decreasing, with time, and has now reached at about 6.25 BTC for every block that is added. So the way the algorithm is structured is that each block is added to the blockchain in about every 10 minutes. And when this block is added, a certain amount of Bitcoin is released and awarded to the miners. This acts as the incentive for successfully processing a transaction block. How to control the oversupply issue with Bitcoin mining rewards? So Satoshi Nakamoto, the person or the group of people, designed Bitcoin mining rewards in such a way that as time goes by, mining will become more and more difficult and the rewards will keep on reducing. This is done to control the supply schedule of Bitcoin. And this is one of the primary reasons why Bitcoin is considered as a store of value. It is this scarcity proposition. So you might have heard that in total there will only be 21 million Bitcoin that will ever be released. And the way that release is going to happen, the supply schedule, is already been built into the algorithm that Bitcoin's running on. So the event that is most important in this entire supply schedule is called Bitcoin halving event. And this event happens after every 210,000 blocks that have been added to the blockchain. So basically 1/100th of the total Bitcoin supply. And what happens in the halving event is that the rewards that are given to miners for adding blocks is cut into half. Like it just falls by 50% after these 210,000 blocks have been added. Because Bitcoin functions as like a time, it functions as relative to time, which I mentioned, like after every 10 minutes a block gets added to the blockchain. This event of halving is also predictable, that it happens after almost every 4 years. So how does the Bitcoin halving process happen? As I mentioned, that this process occurs after every 4 years and reduces the block reward by half. It helps in reducing the inflation rate and the amount of Bitcoin in circulation by half. The most recent halving event happened in March of 2020. Sorry, May of 2020, just post the pandemic, and the block reward was reduced from 12.5 BTC to 6.25 BTC for every block that is added. And as mentioned, that because the supply schedule is so predictable, the next halving event is going to happen in 2024 after the next 210,000 blocks are mined. And in this, the block reward will be cut down to 3.125 BTC. This is going to continue till a final Bitcoin is mined, which is supposedly going to happen in 2140. Another question that we get quite often is around what is a Bitcoin node, or what does it mean to run a full Bitcoin node? The node is just a technical term used to refer to the computers that verify transactions on the blockchain or maintain a copy of the distributed ledger of the blockchain. So hence the number of nodes on Bitcoin blockchain is equal to the number of computers or GPUs or ASICs that are trying to power the network. They are, as I mentioned in the beginning, they are the basis essence that preserve the integrity of the blockchain. They provide the security and the backing to the blockchain, and their strength as they continue to keep growing is helps grow the strength of the network as such. This brings me to the next question around why is Bitcoin so popular. So besides being the first ever crypto project or first ever blockchain project, Bitcoin's popularity can be attributed to the extent of decentralization that has already happened. The number of nodes that Bitcoin runs on is above all other blockchains, and there is an overall sense of transparency because of the public nature of the blockchain, and how each node can actually see download the entire transaction history of what has happened on the network. Another main point for making Bitcoin so popular is the tokenomics. Tokenomics is the release of new Bitcoin into circulation, and as we all know, that I mentioned before, that the inflation rate for Bitcoin keeps reducing after each halving event. So this deflationary tokenomics makes it a good inflation hedge when the rest of the world is facing in an inflationary environment. The current inflation rate is already less than 2%, whereas in the real world, example in the US, inflation rate is almost touching 9%. So what other important traits of Bitcoin make it the go-to crypto for any investor? So because of the tokenomics, Bitcoin is considered as a hedge against inflation. Plus, it also has a huge dominance in terms of market cap in the entire crypto asset universe. So it dominates by about 40 to 45% is the range in which generally Bitcoin dominance is in that range generally, and making it capable of moving the entire crypto markets in the direction that it starts moving. Also, one thing that I want to highlight is, as I mentioned, that the strength of the network comes from the computational power that is put into it. So that mechanism is referred to as proof of work. So there's a consensus mechanism where all blockchains agree, all the node operators and miners agree that this block has to be added to the blockchain. So that whole concept of mining, of solving that mathematical problem, is referred to as proof of work. The question that we often get asked is Bitcoin evolving now? Is it getting more tech savvy, as there are other smart contract powered blockchains around it now? So the short answer to that is yes, but because it is so decentralized, any upgrades to the network really require a lot of coordination and consensus amongst all its participants. So the most recent upgrade that Bitcoin had was the Taproot upgrade, which basically made it easier for people to add more larger transaction sizes onto the block. Plus, upgrades aside, Bitcoin also has a lot of layer 2 solutions being built upon it. So users can build dApps and even work with smart contracts on these layer 2s. The most popular one is referred to as stacks, the token for which is STX. These upgrades and layer 2s sort of add like new privacy features, add new smart contract functionality, and also help in reducing transaction time and help in overall increasing the efficiency of the underlying Bitcoin network. So another question that people get is like, why do I see so many cryptocurrencies with Bitcoin in their name, but not exactly Bitcoin? So Bitcoin was one of the first blockchains to come around, and it has seen several hard forks, because of which they have created new assets from the original blockchain. So now you have Bitcoin Cash and several other popular Bitcoin hard forks. So related question: what is a hard fork? Whenever there is like a sort of disagreement between the network operators, radical changes are made to change how the blockchain should function. That results in sort of a sharding of the main blockchain, and it starts in operating as two separate chains after that. This event is referred to as a hard fork. As for Bitcoin, the hard fork history is pretty extensive, with one starting as late as 2014, and the most recent hard fork happened in November 2018. That is when Bitcoin Cash was hard forked, and the reason for that was a SegWit upgrade that was proposed by for the network, and there were like opposing network participants. The ones that wanted a new asset class altogether, they went ahead and introduced Bitcoin Cash on the other hard fork. The classic Bitcoin continues to operate and will have like 21 millions as the supply schedule. Bitcoin Cash will have its own tokenomics. So when I mentioned like Bitcoin has a fixed supply chain, a lot of people question like, if it is a fixed supply project, what happens when all the coins are mined? So firstly, the last Bitcoin will ever be mined in 2140. By this time, it is expected that the networks would be so strong, and the transaction fee that is generated would help in powering the miners to continue running the network. So you have to consider this in two ways. For each block that the miner puts onto the blockchain, you are awarded X number of new BTC that are generated, but you're also given a transaction fee, which is again denominated in Bitcoin. So by the time 2140 comes in, transaction fee itself would become so profitable for miners to continue validating transactions indefinitely. So one last question or sort of trivia that we get question like, what is Bitcoin Pizza Day and what is the hype about it? So on May 22nd, 2010, Laszlo Haniez made the first ever transaction for Bitcoin versus a real world commodity or asset. He exchanged 10,000 BTC for 2 pizzas. There was another on the receiving end. There was a guy called Jeremy Stodivant who grabbed that deal, and that was the first time ever where Bitcoin was used as a real world payment for a good, and it's still referred to as Bitcoin Pizza Day because of the enormous amount of money that that could have replicated to if that person had continued to held on to those 10,000 BTC. That's about it in terms of what is Bitcoin and why it is considered as an inflationary hedge. I think one point that needs to be again re-highlighted is that the fixed supply schedule is, and the truth around scarcity of an asset is what makes Bitcoin a greater inflationary hedge than a lot of inflationary hedges that are used currently. I give you the example of gold. Gold is supposed to have like a fixed supply, but very recently there were like new caves discovered in an African country which would almost double the supply of gold. Or there could be possibilities of finding more gold deep in the sea, or a comet hits Earth which is full of gold. So the supply for gold cannot be, it is not a constant. It ever keeps on, evolving. Whereas for Bitcoin, there is huge amount of predictability in how the next, Bitcoin will be released, and even the amount and the time both can be determined from beforehand. So that makes it like a very good, scarce asset that can act as an inflationary hedge. Thank you.
Well, that's it from us. Hope this was all informative. Now do write into us at ETMarkets Crypto Corner with all your thoughts and questions. From all of us, goodbye.
Crypto products and NFTs are unregulated and can be highly risky. There may be no regulatory recourse for any loss from such transactions.